All right, joining us here is Ari Pine, who wrote a great piece way back on spoofing, and we thought it was a great opportunity to bring him on the show to kind of start this conversation. And first of all, Ari, welcome to the show.
Thank you very much. Really flattered to be included.
Well, thank you, and it's great to have you on. And thanks for taking the time and joining us. So what got Kevin and myself really interested in having a chat with you is really your outside the box thinking. Is the idea that what could go wrong from rules being implemented on spoofing. But before we get into that, why don't you just take an opportunity to explain to our listeners what spoofing is in the first place?
Yeah, sure. That's probably a good place to start. So spoofing is when essentially it's like bluffing in poker. You're trying to show uh, direction in the market by offering a large volume of futures or stock in an effort to buy a small amount, or showing a large bid in order to sell a small amount. And once you get filled on your small amount on the opposite side of your large order, then you cancel that order. And then the idea being that the spoofer will have purchased at an attractive price and it will go up, or vice versa. Does that make sense?
Oh,
Yeah,
absolutely.
no, for sure. There's a famous trader. Oh, hi Ari, it's Kevin. So there was a famous trader that was the London-based trader, the guy in his pajamas that was living in his
Yep,
parents'
for
house
Sorrel.
trading. That's right. And why don't you just tell us a little bit about him? Because I think most people will kind of know that story a little bit, and what he was doing and what it contributed to the flash crash.
Well, I won't claim to be tight with Mr. Sorrel, but my understanding of what he was doing was actually, of all things, if you read the description, it actually seemed as though he was spoofing from the buy side during the crash, during that flash crash, and apparently somewhat successfully. Um, I, so that's what my understanding of what he was doing during the flash crash was. More generally, he had contracted with a software vendor in order to automate his spoofing, which then actually ended up causing trouble for the vendor, who is now currently going through the courts right now trying to get his case dismissed.
Uh, do you know who the vendor is?
Yeah, it was Jaitesh Thakar. And apologies to Jitesh. I've met him before. He's out of Chicago and ran a group called Edge Tech. I believe it was called Edge Technology.
Oh, I see. And then he's in court now about this. So let's just kind of think about this like from a trader's point of view. What they were in essence doing was trying to bully the market by putting orders on one side that were larger than they really wanted to execute in the hopes of moving the price that direction so they could actually execute like be filled on the other side of the order. Is that correct?
Yes, that's exactly correct. Actually, I really like your term of bullying the market. That's exactly right.
Right. And I guess to some extent, it's kind of surprising, that this is illegal. And I just want to point something out before we go any further. This is illegal, and if you do this, you put in orders that you have no intention of getting filled, you will get kind of fined or even worse, go to jail like this London-based trader. So by no means are you, unless like from your article, you very clearly point out that this is illegal and you shouldn't do it. But you had in kind of an interesting take in terms of what the consequences of an exchange or kind of a regulatory body enforcing this practice does to the market. Why don't you tell us a little bit about kind of the implications if nobody is allowed to bluff the market?
Right. So first of all, not only do I think it's worthwhile to emphasize, just as you did, that it is illegal to do so, but it's also worth noting that every order, right? So if you're a spoofer, you normally are looking to trade 5 lots, but you sell 300 at a certain price in order to buy your 5 lot. You're on the hook for that 300 lots. So
Right.
it's worth noting these are live orders. You have to have the credit lines in place with your futures broker or your equity broker in order to place these trades in the first place. So it's worth noting these are live trades. And so, and another thing that's worth noting is that although the spoofer puts up, let's say, offers 300 trades at 66.72 to buy a few lots at 66.71, they're not filling their own order. What is actually occurring is somebody else, another trader that's looking at the market, sees, hey, there's selling interest at 300. Let me get ahead of that order. And I'm going to go sell the 66.71s, which is exactly what the spoofer wanted them to do. So it's worth noting that the spoofer is not actually transacting. They are on the other end of the order, and you can look at those traders that are hitting the spoofer's bid as being trying to front run that perceived 300 lot order. And that's exactly
so it's kind of right. It's kind of hilarious that the people that were actually complaining about the spoofers were kind of high frequency guys in themselves, right? Like I think I saw, wasn't Citadel one of the complainants about this kind of practice?
Not only is it, of course, ironic that, yes, it was Citadel and a couple of others, but it's amazing how blatant they were in what their complaint was, which was to say that they were having trouble figuring out which way the market was going.
the nerve of them. It's kind of like a man bites dog situation.
Yeah, and so it never clearly there's a number of questions that raises in and of itself, but it is rather humorous if it wasn't bad for the market. So going back to your other question, what is the expectation if you ban bluffing? Well, and what I brought up in the article was, imagine if you were at the poker table and you were part of a group and you're normally used to bluffing, but you're a straight shooter. You just bet based on what your hand is. You don't pay attention to what other people are doing, so you don't really care whether they're bluffing or not. Great, you're a straight shooter. Well, if you all of a sudden know that bluffing is absolutely not allowed at this table, that has to change your entire outlook on how you bet, because all of a sudden the betting from people has exact information content. You know that they're only allowed to bet according to what they think the probability of their hand from a strict mathematical perspective is. And the same thing goes in the market now, because whereas before you weren't sure whether the orders in the order book were real or spoofing, now you know that the orders in the book are real. So as a consequence, if you are what we would say, right, when you were on the desk before, right, the real money orders aren't going to feel comfortable placing their orders in the order book, because they know that they're going to be exposed in the same way, right, that the tide goes out and you can see all the fish. So
in essence, they made it so that it's even easier for the HFTs to pick off the real orders, right? Like that's in essence what they're saying. They're making the market, and the consequence of making it so that only real orders can be placed means that
real orders
that those real orders, right, will try to hide them more by going to other venues, right?
Yeah. So which is natural. You can't really blame them. So then they want to go to a dark venue, but this ends up if volume goes to dark venues rather than being lit, it's very bad for retail orders, because those one lots aren't really going to be there. All of the liquidity is going to be elsewhere. And that was really one of the nice benefits of having these electronic markets, is that you were able to go and trade your one or two lots the same way that anybody trading treasury notes, from me doing a one lot to Goldman Sachs trading thousands at a clip.
Right. So Ari, I'll tell you a story. I used to sit on the desk at a Canadian bank, and when I used to trade, we used to stick fairly large orders in the machine. Like when we trade predominantly equity, so I would go and trade tens and 20,000s without blinking. And in fact, when
Mhm.
there was liquidity, I would be happy to swap like 100,000s with people. I've come back now to the buy side and have been kind of trading in the market. And every time I go with the 10,000 lot order, it just, I get everyone disappears and or either front runs me and there's nobody to trade with. It's like the market is being ruined. Like I just think it's terrible. Like it's just
Yeah.
like it's nothing like what we used to have. So I have some ideas about how to fix it or what might be done to change this. Do you have any?
Well, first of all, obviously, from my perspective, I think spoofing ought to be allowed. It's not a strategy that I've ever done because it essentially is selling small options, and I tend to identify more with long option or long convexity positions, right? Because if you
Right.
think about it, putting a 300 lot on the screen, you can get lifted, right? If you're a smart guy, you go, hey, I'm looking for the spoofer. That's an opportunity for me to get in at a good price. Then you can get taken advantage of, and you can. That's why sometimes you'll see back in the day, the prices will go very quickly when an order went, is because people got caught offside on situations like this. Um, I would think another way of going about it is so one of the trends that I've also seen in addition to the spoofing is that the exchanges, and I think primarily because they've been converted to a for-profit mechanism, is that um, they've really focused on their highest volume clients. And so they provide discounts and so on, which is really understandable. I mean, why shouldn't they be able to provide high volume discounts to their best clients? And so it appears to make sense. But what happens is it becomes very uneconomic for smaller traders that might be providing some of this little back and forth in the meantime to become active. So it's very expensive in terms of data fees. They're not getting rebates on their contracts in the same way that you would if you are, a Citadel or a DRW or whatever, where these guys are big and obviously very profitable customers. So it seems to make sense on the surface, but from a um, regulator standpoint of wanting to have a broad base of differentiated participants in the market, it's been harder to do.
Yeah. So I agree. Couple of the thoughts spring to mind for me. First of all, I agree with you that the real problem with spoofing is the fact that guys are going and putting orders that are risking the integrity of the system because they're much bigger than the equity in their account. So one of the big things that I kind of pushed back on was this guy was trading a 300 lots, this London-based trader. Did he actually have the margin in his account to trade that many contracts? And if he did, I kind of think he should be allowed to put in whatever orders he wants to put in, and that shouldn't ever stop him. But if he only had $20,000 and was offering this 300 lot to try to get it, like that's my kind of worry, is that it ends up being a risk to the clearinghouse mechanism, because at the margin, what if he does it with a 2,000 lot or a 5,000 lot, and it gets more and more scary that way. But the other part that kind of it's such a simple solution, is that just make the orders have to stay in the book for like a second or 2 seconds. Realistically, everyone that puts in an order should be willing to stand still for a second. And if we do that, it'll change this kind of idea about it'll change the whole game. And I don't understand why more people don't just come around to this idea that we just make it, or make it a random kind of point. Like maybe it's like anywhere from 10 milliseconds all the way up to a full second, so that you never know how long you're in there. And you take out this whole kind of ability to know exactly where you're at, and introduce some kind of randomness, so that the people that aren't that are just not really adding any value, but merely front running and kind of taking advantage of it, are no longer the ones that are able to do that. What do you think about that solution?
So part of my background has been as a bit of a spread trader, doing some quantitative analysis and putting trades on. And one of the things that you do is, I might trade contract A, but I'm trading it against contract B. So my bid for contract A is dependent on B. So a lot of times I would be putting orders that are either spaced, away in some way. And so I would do it's not so much that I would cancel after a certain amount of time, but it would be dependent on something going on in a different market. So I'm not sure what you're saying makes a ton of sense to me. I don't know how you would address the fact that there's a significant portion of traders out there that are doing contingent orders, where, you may want to trade either a calendar spread, by legging it, or you're trading gold in one market versus another, or trading a spread between a couple different metals or so on, or something like that. So I don't know how that might work, but maybe you can break it up into auctions that are spaced apart.
Oh yeah, that's true. You know what's funny, Ari, is that in my old previous life, I also did a lot of that kind of arbitrage between two markets, and so we were one of the first to do interlisted arb versus the Toronto Stock Exchange versus the New York Stock Exchange, and it was before the Americans had kind of figured it out and driven the spreads to zero, and it was actually we automated the process, and this is in the '90s, and it was a terrific business and stuff, but. For a long time, it just the fills were such that it would take like seconds, and you wouldn't know if the exchange was going to be busy at certain points and stuff. And it's kind of just shocking to me that the precision that now people are trading on, and the kind of what used to be kind of something like a certain amount of risk that I was willing to take is now become like. It's kind of shocking to me that people are talking in microseconds when I was talking 2-3 seconds seemed something that was perfectly acceptable for waiting for a fill. So it's in another league, and it's just I just find it kind of shocking to me, though, that we're sitting there getting mad at people for going and putting in these orders into the exchange, that the spoofing, and meanwhile the HFT guys aren't really adding as much. Not that the guys doing the spoofing are adding a ton of value, but at the same time, it's the pot calling the kettle black to me. It just seems completely and utterly wrong. And if you want to put in an order, as long as you're willing to get filled, you should be allowed to put the order in. I just feel strongly about that. And to some extent, I think that the market would figure it out. So if he's putting in an order that is not real, then that's in essence an opportunity for size to buy an offering that's not real. So I don't get why people don't say, well, he's exposing himself. There's a weakness there. I'm going to buy it.
Absolutely. I don't know how, I don't know whether, if you're, say, a big player in the market that, maybe run a screen on what the typical size is, and there's something that's outsized there, and whether there's a way to statistically tease out a spoofer versus a real order,
right,
or something along those lines. And actually, that exact question is exactly that gets at the heart of why we ought to have the spoofers there, which is to say, it provides it forces uncertainty in decision making. And so what happens is that people just really don't know. And because they don't know, you have to respect that a little bit. So respecting uncertainty is part of trading. And I think it's also really worth reiterating that all of these arguments that we're talking about are all dependent on what I think is a very true statement, which is these are live orders. And secondly, although you can't guarantee this because each clearing firm may, be different in terms of what their credit assessment is, but presumably these clearing firms are only allowing an extension of credit to the extent that the spoofer, meaning that their customer, can afford.
Right.
Right.
Right. So it's assuming that, then you kind of have to argue that they should be allowing them to do the trades. But anyways, Ari, I really appreciate you coming on and spending some time with us. Why don't you tell us a little bit about
yeah,
where
actually,
we can
before we do that,
find
like
you?
I just want to show here for our listeners and watchers here, if you want to get the article that Ari wrote about this, if you go to the medium.com, you just Google medium.com and then just the name of the articles, everything you thought you knew about spoofing is wrong. So, and you could type in Ari Pine's name in the Google, and I'm sure the article will come up, and you can read a really amazing article he wrote back then, and just explains everything in there. So you can find that there. But as well, like Kevin, like you were saying, Ari, if you want to just let all of our listeners know where they can follow you and where they can learn more about this stuff.
Yeah, I'm on Twitter. I'm belying my option background. At Standard Dev on Twitter, and I believe it's STD_DEV. And I'm sure you can look up Ari Pine on there as well. And then we have an entire blog from Digital Gamma, which is my current company, and we put out a few articles every so often talking about various things.
Well, that's terrific. Well, thank you very much for making time for us, Ari. I really appreciate it.
Thank you. I'm really honored to be a guest after listening to so much. Thanks.
Thanks again.
All right,
Take
thanks,
care,
Ari.
Ari.